Hey everybody, Al Labarola for Financial Intelligence Trading. As you can see from the backdrop, I'm back in my favorite spot in Laguna Beach, California. Now, I left my trusty stand back east, so I'm winging it here today. Sorry you're missing out on a lot of the gorgeous backdrop. But enough of that nonsense because we're going to talk about the markets. There is a ton that's going on. Thursday saw the end of a 5-day slide finally halted on the news. Well, can I just say the hope, because I'm not sure it's actually news, that maybe trade war tensions will actually subside ahead of the G20 meeting in Buenos Aires. But then we come out and we say that we're going to add 25% new tariffs in January. These guys are killing me. Now, if you're a chart watcher, well, then you've had your eyes glued to the S&P this week because of that inverse head and shoulders pattern that was forming and failed on Wednesday. Now, the Thursday leap, well, that could argue that it was an overshot, meaning the Wednesday slide. On a side note, by the way, I saw a very funny tweet that was wondering if the pattern, that inverse head and shoulders pattern, was still intact, even though the right shoulder looked like the hunchback of Notre Dame. By the way, Notre Dame has a top 4 ranking. How about them Irish? So back to the market. Ray Dalio says the world is in trouble because everybody's long stocks. Tudor Jones says we're in a global debt bubble and we're going to see some serious pain in corporates. Yet Fed Chair Powell says market volatility, it's just one of the things that the committee looks at when setting policy. That sounds like a rate hike to me. And then the little hope, the glimmer of hope of a trade war dismissal, bang, sends markets roaring. Watching this day-to-day price action, it feels very much like walking through one of those mirror mazes at the fair. It's going to smack you in the face each time you turn around. So with debt to global GDP ratio at all-time highs, housing, auto, industrial stocks, just to name a few, making 52-week lows, well, that sounds like lower GDP might just be on the horizon, and that would argue for Tudor's case. Well, macros have already been in a slight contraction. And if GDP slows, well, we're going to be pushing deeper down that chain. So you need to ask yourself, if your allocation in stocks has no modifications, what will happen if the market goes down? Look, if you have 70% stock allocation and you stay 70%, to me, that's like driving 70 miles per hour all the time. Sometimes you just got to slow down or you're going to get in a wreck. Now just might be one of those times to think about that carefully. So if you're trading these mirror maze moves, please remember that stock and stock options involves a substantial degree of risk. It's not suitable for all investors. If you're watching the charts like you know I am, well, past performance is not necessarily indicative of future results. I'm Al Labarola for Financial Intelligence Training. Thanks for watching, everyone. Have a great day.